All right, folks. If you don't know it by now, Greenleaf Connect's mission is really to be informative and provide transparency throughout the organization. We host weekly live streams and private Connect events on really anything from deal launches, quarterly updates like this one, market trends, so on and so forth. Private Connect events are more interactive while live streams are open to the public. All right, before I pitch it over to our two hosts, really today, folks, we will be conducting a market overview. We'll discuss specifics in topics like occupancy, cash flow, reserve position, our value position, and strategic direction. And at the very end, we'll be doing a Q&A session using that Q&A feature at the bottom of your screen. All right, without further ado, I will pass it over to our two hosts, Dave and Andrew.
All right, thank you very much, Dominique. Welcome, everyone. Today we're gonna touch base on a little bit of what we talked about last quarter to see how things are doing. So we have a couple core points here. One is just 2021 so far, which we see a little bit of eerily similar stuff happening each quarter. We've got some forecasting stuff that we want to go over. We're always going to be talking about data and how we're utilizing that. We have our foot traffic data that we're really relying on right now, and then other points from COVID that are sticking around. So we think about these from this year.
This is our favorite picture right now that I think most people on this webinar should actually know. We had a whole conversation about this. So it was a good 10 minutes.
Oh,
yesterday.
like a movie trivia to see if people actually know.
This is a movie trivia question, so hopefully everybody knows where this is from.
But you know, as Andrew and I were putting this thing together, we kind of feel like we're going through a lot of the same stuff each quarter with what are the key points around stimulus, what does work from home look like, and how COVID became such a politicalized topic, from just the virus itself to masks and vaccines and
working from home, not working from home. I like working from home. I don't want to go back on an office, or I really miss an office and I want to be there, and a team can't be productive outside an office. So, but these conversations have been happening. We talked about it for a year and a half now, and they're not changing. So unless there's some transformation in some type of the spread or transformation in vaccination, it's going to be the same conversation. And I don't like saying this, but I've sat my wife down and said, Janet, this is the new normal. I mean, this is going to be the foreseeable future for the next few years, and something transformational happens with COVID or with the spread. And I mean, it just is what it is. So how do we adapt in that situation?
Yeah, and we're going to talk about some of the stuff that, you know, these three big things happened, and then it kind of going into COVID, we were looking back like 2020, and everyone had their own kind of forecast of what things were gonna look like, and we call it the big forecasting miss because almost nobody was right. I mean, we certainly weren't right. We were expecting COVID to be bad for incomes and asset growth. And the chart we have up here, as we go back and look at March of 2020, you know, U.S. household income skyrocketed during this.
Oh, and don't forget, Walmart and Target are now paying people $15 an hour, which they did not do pre-COVID. So that came out of nowhere too. And so the whole conversation about the minimum wage, it happened.
Yeah, that was a big topic.
It was a big topic, but all of a sudden it went away because supply and demand has said wages are going up regardless of what the minimum wage is.
Correct. Yeah. So we see this, the thought of COVID coming, and all of a sudden we have this huge monetary stimulus, a massive shift in work strategy, constraints on consumption where, like, hey, some industries like cruises and movies, like, those are not happening, but people have all this extra money, so they're spending it in other locations. And just how, as a, you know, globalization with all the intertwined parts of the world working together, like, really threw a wrench into what was happening.
Right. And supply chain has some odd things happening. So I went and ate at a restaurant last week, and of all things, I asked the restaurant manager, how's his supply chain, and is he missing any food? And he said, mostly we're okay, but every once in a while, like, we're short on to-go boxes, or of all things, he's short on straws. He said he actually had to go out of his way to find a place to find straws because he was literally out of them.
Yeah.
And his normal supplier didn't have them. So there's odd little things happening. And if you go into any type of Target or grocery store, if you walk down the aisle, you will see one little empty space on the shelf that is missing some product.
Whatever that one product is.
Whatever
yeah.
that one product is.
And that's as that relates to our commercial business and especially our retail business, it's critical for us to understand, to be seen like, hey, what things are happening so that we can, work through any issues that do come up with the tenants we have or the retail businesses as we're underwriting them and seeing what they're doing. In this chart you see here, this is just what dry shipping costs are. And again, we're not involved in any kind of port business. We're not distributing any materials. We're not doing any of that. But this is just an example of, prices went up 3x from the end of 2020 until now. So any business that wants anything, the cost of getting it here is becoming much more expensive. And there's lots of then now constraints. We've heard all the news, like ports are all backed up, right? And we've got a picture of the LA port. It's like there's just stuff waiting.
Oh, here's a good friend of mine is opening up a cafe right now, and he literally has told me he's following his equipment on a boat off the coast of California right now. And he's watching it literally on the internet.
And it does impact us as we look at our, we'll go into our deals, but we've got deals that we've gone through renovations on, and we'll touch base on those, on which ones that have been impacted from the supply side. This is another interesting point. 3 months ago, everyone was like, man, lumber prices are through the roof. And, we were thinking about that. It's like most of the lumber, a lot of it comes from here in the U.S., but then you still have transportation issues. You still have working issues with, are you in and out of mills, are they working or not? So prices skyrocketed for a period of time this summer, and then now they dropped all the way back down. So it's another price point that we're seeing as kind of these three main decisions of stimulus, how we're working, and COVID have rippled through all the economies globally. We have these kind of uncontrolled spikes in various sectors of the economy. Maybe straws are the next thing that like double or triple in price.
Well, we had toilet paper early in COVID too. Don't forget the toilet paper.
Yeah, toilet paper is always a good one. People
yes,
love stocking up on toilet paper.
Yes.
But it's happening in very different segments of the economy that seem like they're not related, but they're all three different from these three main points that we're seeing. So as we keep that in mind, we're trying to make sure that when we're making decisions, we're not getting kind of like lost in what's happening here with the lumber price or lost in what's happening in dry shipping rates. Like there will become like an equilibrium where things even back out.
Right, but we're focusing on things that are beyond the supply shortage. We're focusing on long term. What's this business going to look like? What did it look like before COVID? What does it look like during COVID? And what is it going to look like coming out of COVID?
Yeah.
And so, honestly, one of your favorite topics I know is always foot traffic.
Yeah.
How many people are walking in that Dollar General? How many people are walking in that Applebee's? And how many people walked in the Applebee's before COVID, during COVID, and what's going to happen after? So
we look at a business, like all businesses are reacting to the same things that are happening right now.
Yeah, and sometimes it works out for us because when we have well-funded branded restaurants that are competing against mom and pop brands, who closes their doors first? It's unfortunately always the mom and pop brands, but the bigger brands will survive and stay open, and we have to. That is one place I think where we're leading. We're always buying the place that's going to. It's a sound business on a good piece of dirt, and so when you have
with strong operators.
Well, strong operators, and when you have the mom and pop just operating the casual restaurant, they can't compete against the Applebee's because Applebee's is going to have a huge cash balance sheet.
Especially when we have any kind of random ginormous spike in any kind of commodity price.
Right.
That's really hard for a small business to handle.
Well, in fact, all of these restaurants have literally, they went right around March or April, their staffing literally went from a fully staffed restaurant to bare minimum staff just to keep the doors open. And then they literally had to build their business back later in the year to restaff it and start functioning like a normal restaurant again. And so they actually even all these restaurants had to reinvent themselves and reinvent how they did business because their 2019 staff looks 75%. It's probably almost completely changed over from their 2020 and 2021 staff.
Some businesses are obviously better at doing that than others. When we talk about the larger brands that are good at doing that, we have an Applebee's that we're doing tomorrow, right? That's on
doing tomorrow.
Doing tomorrow.
Yes.
But their post-COVID sales are better than their pre-COVID sales. They adopted their business model. They have a portion of their business that's now carry out, take out, delivery. Like they didn't have that before COVID. They have adapted, and now their
Yeah.
business is doing better.
Well, Applebee's
which-
is also a favorite topic of us here
Yeah.
too, and there's also.
But we're trying to we're looking for data points that give us like, hey, this is a brand that can get through this, or this is a segment that can perform well.
Yes, and
knowing that there's going to be variables.
I think the words you used are professional operators. So they have professional operators in place. They have policies, procedures. They have mentor programs. They know how to. When a manager quits, they know how to replace that manager pretty quickly. When staff quits, they know how to replace that staff. They just know how to do this because they've done it 100 times. Actually, not 100 times. They've done it 1,000 times before.
Yes. And the information we have up here on this one is even within a brand. We like a brand. We've spoken a lot about Applebee's, Zaxby's, Dollar General, even all our
DQ.
medical tenants.
DQ Grill and Chill. Yeah.
But we have our medical tenants as well. We bought a lot of VA clinics. We really like them as a tenant. And we can look at all of the VA clinics and say, hey, which one is a strong performer or a weak performer? We know their business model of where they need to have locations, and we can then determine which ones are the strong locations. And we can apply that to all of the brands that we operate with. In this example, we just have two different stores, right? Same brand. The brand is all, in this case it's Dollar General, but we could call it any one of the brands that we are currently going after, or any of the asset types, and we're really looking at like a medical specific tenant, and we can see a variable range of performance. So this top one, you see they're in the bottom 35% of store performance nationally, whereas the lower one that's in red, right, that's one's 87th percentile.
I think I'd rather buy the bottom one.
Yeah. So, all right, so when we look at this information, we're going to go through how did this impact the commercial assets that we currently have. We have a wide array of assets from office. We're working on some of our first industrial deals. Obviously, our retail business is a fairly large component of all of our commercial assets. And then we have our medical tenants too.
Yeah.
So the big difference between the two when we talk about commercial versus retail. On the commercial side, it's very much like an operational team is involved. We're actively doing new leases, lease renewals, negotiations, maintenance on a property, and overall supervision. When we go into the retail, it's a little bit different.
All right. Well, retail's typically always occupied. And by the way, I just realized that we hit our milestone with Zaxby's. Zaxby's was our 10th official closed retail
All
deal.
right.
So
That
that
was
was
really cool.
a
Yeah.
milestone for us. And great deal, phenomenal deal, and it's also an operator partnership, which we're going to talk about later.
So, in the retail deals, once they're in, we have 5 to 15-year leases on one single building. So there's not a lot of day-to-day work that we're doing on those assets. We're more managing the relationship with the operators to find opportunities, and then ensuring that we manage the lease and the debt to coincide with, to get the best spread on our existing cap rate versus the debt rate.
Oh, and by the way, somebody corrected me on our longest lease. Our longest lease is actually DQ Grill and Chill, which was 17 years. So we do have a longer lease than 15 years.
Okay, we got one longer.
We got one longer, so that's good. It's good
Yeah.
news. Yeah.
All right, so the bottom part here, we're talking about occupancy change over the last quarter, and almost every quarter we have, we're gaining occupancy across our commercial and retail assets. So retail here, we have full occupancy on every asset that we have,
Correct.
right? How many tenants do we have total? Because we've got a couple at the in the Panera Center.
Whiskey
They have
Road
4
has
tenants.
4 tenants. We've got
Yeah.
we got the Panera, we've got the Aspen Dental, Mattress Firm, and the Vitamin Shop. So we have 13 retail tenants right now.
Yeah.
And Grapes and Grains would be 14 then.
Yeah. So all of those are fully occupied and doing very well. We jump on the office side. The office side is really the area where we have, we even know going into the office side, like that's the area where we can create value by driving occupancy and doing renovations. So we have a couple deals here. You can see they're in the QOZ. Those are highlighted in blue there. And then we have Parsons, which is it's a big medical facility. We just have 2 vacant spots. But here we have Lupton and 1500. Those are the 2 QOZ deals. The Station, Johnson Square, and Crossing are all office deals that we have been actively leasing. We had a good amount of lease activity this quarter for the Station. It's kind of one of these, it's steadily improving every quarter, but we're also signing 500, 1,000, 2,000 square foot leases. So we are not signing a 20, 30,000 square foot tenant to just immediately see that occupancy jump up to 95%. So this deal is going to be stepping stones of new leases on a quarter by quarter basis. The same can be said for Johnson Square. When we closed, really when we went under contract with Johnson Square, we were in the 60% occupancy range, and now we're up to the 80s. But here, we just started a big renovation project. We had this in the works as we were closing that deal, and now we're fully redoing the outsides of these buildings to up that kind of curb appeal, and then we have a lot of HVAC work and mechanical work that we're doing on the remaining vacant spaces. And the only other one we have on the medical side, we have Parsons that has 2 vacant suites, and then we have 6160 Peachtree, which we actually just signed a spine center that's moved in there, like a physical therapy spine center. So that was our latest medical lease that we just signed with them. So we bought that one at about 40% occupancy, and now we're up to 60% occupancy as we sign new medical leases and move them in. So everything else we have is very well occupied. You can see almost all of our assets are 100% there. So it's very exciting.
It's pretty good. And for retail, your father loves his checks every quarter too.
Yeah,
Every time I see him.
As we jump into kind of what our cash position looks like, right? It's like if we have occupancy and we have cash, that means we're able to make distributions on a quarterly basis.
Yeah.
Everything we're trying to do is cash flow driven. We are trying on every deal to ensure that we get to a point where we are able to make quarterly distributions. And retail's really been leading the charge with that.
Yeah, so retail's the most reliable, well, I don't want to say this, but one of the more
We're
reliable
not knocking
payers.
anything else, but they're very reliable.
Because basically the quarter after closing, investors are getting a check. And what happens with retail or all the triple net deals is the income stream is going to be a very reliable income stream from a professional operator. So we know the variation in a triple net deal is going to be a lot less than the variation like in a Parsons or a
there's only one
station.
tenant and they've got a longer lease. And
and literally you can map it all the cash flow out. And like for a Dollar General, you have somebody you pay to mow the lawn. So how much does it?
like $100.
Yeah, it's about $300 a month. But how much is that going to change over the term of the lease? It's going to change $50 a month or something like that. So the predictability of those leases are a lot better than a lot of other assets.
And you see on the retail side, cash wise, we're fully funded for all our reserves here. And you kind of wonder like, hey, well, if they're so stable, why do we need reserves? And we had a deal in our triple net fund that was a individual operator of an individual store, not a franchise operation, and they did close during COVID. That was the only commercial thing we had that did close during COVID, and we replaced that operator. Now we did that. We were able to do that too because we had sufficient reserves there.
Right, and we did great too. I mean, we actually went from $12,000 a month rent to $16,000 a month rent, so we actually did better with the new tenant. But we did have a little bit of vacancy in there, and we had to go through a process, which was not fun, but we did it.
It was a little bit of work.
A little bit of work, but we came out ahead of the game.
Yeah.
We came out ahead.
Then you see our other assets, again, kind of going to the QOZ on the office side, if we're over there, we have 2 deals that are basically fully funded, right? We have TVTC and we have the Crossing Center 2, which we just purchased. These are all fully funded. The QOZ deals, those are the big renovations, so they have not tried to earn up any of their reserves. And then you see Johnson Square, and we have a number 35% here, and it's like, well, what the heck's up with that? I thought we closed with the right amount of cash and we were ready to go. But here, as we get into a renovation project, we're always trying to minimize the amount of debt that we have to use. So we're starting the renovation project and spending current cash, knowing we will do a bank draw to get us to our reserve amount. We don't want to draw too much, so we'll draw just enough that we can be at our reserve thresholds appropriately. But when we're going through a renovation, that ebbs and flows as we do our work and have to pay our vendors. So there we see that our reserves are below our target, but we're in a good spot because we're using that right now for CapEx. Now, in the middle, the big chunk in the middle, this is all medical related tenants that are in the center here. This has really been the focus of our commercial side of the business, is finding these medical tenants that we can do a couple things with, right? One, we're looking to see if there's spots that we can buy with some vacancy and add tenants into it. We were able to do that with the 6160 Peachtree deal. A lot of these other deals, they already have their long-term lease, and they have a long way to go on them. So MNG and 1824 Hillendale, which is a VA clinic in Raleigh, you see it shows that their cash is below 100%. And that's because when we went into 1824, we had a lot of CapEx that we're doing, and we have started doing the bulk of that work now. So now we're looking at a cash position where we're spending cash to make sure we complete the CapEx that was required. Everything else on here, when you see it's at 100%, that means they're making a distribution. And we lumped all the retail ones together, but those deals are all at 100% and making distributions. We carved out grapes and grain on the right-hand side here. This deal did go through a big renovation, so it's now going to a point where it's got to work up its reserves. Now, we've already done our refinance. This store actually opened last week, so it was very exciting, and we're pumped that they're open and working. We did our refinance already, like I mentioned.
And it made the news too.
It did, yeah.
Made the news.
You know, it's 24,000 square feet. It looks incredible. We're going to get some other videos out of what that store actually looks like. But right now we're working on building our reserves and then starting our distributions. We'll be able to do that as we really finalize the construction. We have a little bit of sewer work there left to do, but other than that, the deal is open, operating, and that was really our first retail deal that we took from nothing, fully renovated it, and got a new tenant in there. So it's kind of proving the case that we can do that even on the retail side,
Right, and
just like we've done over the years in the apartments and mobile homes and everything.
That store was full of I don't know how you would describe it, but just full of antiques and full of it was a hoarder's warehouse. It was
it's every time we find a new opportunity, most of the time other people look at them and are like, "What the heck is that?" And everyone on our team gets all excited because we're looking around and crawling through things. They're like, "What are we finding?"
Yes.
So that's been it's been a very unique deal, but it's been fantastic, and we're very excited about the where it's at now. But from a distribution standpoint, all of the deals that are green, those are all the distributions that are going out. When you receive your quarterly statements, you'll see all the distribution amounts tied to each specific deal that's here. The ones that are yellow, those are the ones that they're going to have more details that we just kind of went through on why they're not making a distribution. Okay, we're going to jump into just what our opportunities look like for the rest of 2021. So we really have these 4 core segments of the commercial retail business that we're operating. We have our medical and our retail. Those are the bulk of what we've done. We still, I know office is kind of a tricky word, but we still see opportunity in the office space. And then we have the industrial flex deals that we are just recently rolling out. So when we think of medical, our business plan there has been the same from when we started. We're looking for under-occupied assets that we can lease, and we can do the TI build-outs, and we can make it a more attractive asset. And on the other hand, we're also looking for stable, because stable medical assets right now are getting just tremendous debt through the markets that are out there right now. So we can get low 3% debt and buy a 7 or 8% cap rate deal, and it produces excellent cash flow from day one going forwards. So we're looking for both aspects of that, the stable one, but also the value add one that we can convert into stable.
And for retail right now, we're doing something very exciting. We're actually expanding our footprint. So typically we've been in Georgia, South Carolina, North Carolina, Alabama. I think we've done our first deal in Alabama.
We were traditionally sticking to 85 and 75,
but now
we had to physically get there on the operating side.
Right. So now we've expanded our footprint. We're buying a deal in Kentucky right now. We've also expanded our footprint. We're looking in Florida and Texas right now. So we're becoming more of a southeast footprint with Texas. And then we are really good at looking at 100 deals and finding the top 5 deals that float to the top. And so what happens is that limits us because we're always buying the top deals. But if we're adding new markets, hopefully we're finding 10 deals instead of 5 deals because we've got 3 bigger states involved in that. And so we're focusing on that. We're also very excited about focusing on our partnerships. So we're looking at partnering with existing franchisees and helping them expand. We're doing that right now with Taco John's. We've just closed on it's my 3rd Zaxby's with the current franchisee named Chris Moore. We're having an event on the November 18th, I believe. So please join us November 18th at Zaxby's, and you could meet our operator and come see our new Zaxby's. And we're always looking for that undervalued opportunity. So we're always finding, we, like with grapes and grains, you saw something that other people didn't. And so right now, I think we're doing the same thing. We're getting really good at Applebee's, and we've done really well. And
but we know the brand inside and out.
We know the brand inside and out. I know the operator of it. I know the corporate office. I've had lunch with the local operator here, so I know the brand pretty well. And so we're building partnerships. We have partnerships with Taco John's franchisees, Zaxby's franchisees, Applebee's franchisees, and by default, the same company actually does IHOP franchises too. So,
just in case you want to get breakfast.
IHOPs are really expensive though right now.
So our other parts too, like office. So a lot of the big office, and we're not looking at anything that's like big urban towers. I think they have a lot of headwinds. They've got a lot of challenges. But when we think about what we've always stuck to, kind of our garden style 1 and 2 story. Facilities that have good proximity to other things that are there, especially residential. That's where we look at the Crossing Center or Johnson Square. These are 2 deals that there's a ton of other retail, restaurant stuff that's right there, and then the whole outside of that perimeter is residential. So now we're taking people that are moving from a high-priced office to a significantly lower-priced office. We're talking going from $40, $50 square foot to a $10, $15 square foot, maybe $18 square foot rental rate, and it's right next to their house. So that works for some people. There's some that are fully just not going back to the office. Bigger companies, they got other challenges that they're working on. But smaller companies with a small office footprint close to residential, we still can find under replacement cost values there, and they're occupied and people are going there on a daily basis. So we like those opportunities, but they are very tricky to find. There is not that office product doesn't exist out there a whole lot. So finding one that meets the specific demographics we're looking for is certainly challenging. But when we do, we're excited about it, just like the Crossings deal that we just closed. And our last segment, the Industrial Flex segment, we have 2 deals that are coming out with this right now that we're very excited about. But overall, in this market segment, the current rental prices, meaning the current lease rates that people have on their leases, are about 50% of what the market rates are for current demand. So when you think about like any kind of renewal or any kind of value add situation, all of these deals that we're looking at in the industrial flex space, we're able to realize significantly higher revenues because there haven't been a lot of changes in the market prices going back 5 to 10 years.
Well, one thing is also you have to look at the footprint of where we are. And when you look at Atlanta, the Atlanta market versus a market like California or New York, we're super cheap still. And so when a California investor looks at something for $200 a square foot, they don't understand
it's a different world. Atlanta in the southeast is still very much affordable compared to other parts of the country.
And in 20 years, what happens? Do we catch up, or does California become even higher and Georgia just sort of?
I think that might be a whole other discussion.
Yeah. So
it's like, is the South going to? No,
I just want to make sure I want to be holding something over the next 20 years. Yeah.
So, and this is also industrial flex, is an area where we are able to find underperforming assets from an operating standpoint. When Josh and I first started Greenleaf, we were always operationally driven, and we wanted to find assets that we could operationally improve, and we see a lot of that same stuff that we saw 13 years ago when we were looking at single-family houses and small apartment complexes. We're seeing the same stuff now in this industrial flex space that we can take advantage of. So, all right, we're going to jump into just other opportunities and what our deals look like for 2021, for the rest of the year here coming up. So we have...
is it the Taco John's in the top right?
Yeah, that's the Taco John's on the left.
Top left, yeah. So we got that coming out. We have a little bit of room left in that, and that's our first franchise partnership with this with two young franchisees.
Yeah,
they're doing great. This is going to be their 10th unit, and I just spoke to him a couple of days ago or a week or so ago, and he said he's actually looking at more deals right now too. So we might have a second Taco John's coming, and this is our first deal in Kentucky also. So we're expanding our footprint to another state, which is very exciting. Family Dollar is in the middle. I think we literally have about 2 or 3 positions left in Family Dollar. This is about to close out, and surprisingly, these are all going to close around the same time before the end of the year. So these will be.
Yeah, we still have lots of stuff that we're sneaking in before 2022. And these other 2 deals you see in the middle here, one of these the one in the middle left there, that's what our industrial flex typical deals look like. You're seeing a one-story brick or block, like big cinder block, basically construction is the main exterior. Then in the center of the screen here, we have what looks like a city in itself, and this is a very large deal that we've been working on in Chattanooga for almost a year. And that deal is going to be coming out soon, and we have lots of government and medical tenants across almost 300,000 square feet, and I believe 11 different buildings that are in this complex that are all right next to each other. They're all the tenants that we want to see, and we've been able to put together a bunch of them into one deal, which we're super excited about. For us to find deals like that, they take a long time. They're challenging to find. It's kind of like everything out there right now. But we are pumped about this one just because of the quality of the tenants that we have there. And that'll, obviously, the better tenants we get, the better debt that we're able to get, and the better the cash flows look.
And since Dominique put this on the slide, I'm assuming I'm allowed to talk about it now, but we just we signed an LOI literally over the past few days on a new Applebee's in the Metro Atlanta area. Once we get under contract, we will let everybody know. But if you're interested in that, send your interest to Dominique, and Dominique can pencil you in for something. But that literally is, and that's also from a partnership from a local franchisee also. So we know the operator of that Applebee's because they operated the last two.
Yeah, and that's how we want to, that's how we're going to grow the business.
Yeah.
So keep finding the best value deals that we can. So, all right, we're going to turn over to Dominique now, and she's going to go through a little bit of what our next schedule looks like.
All right. Thank you, Andrew and Dave, for sharing your insights with us and a sneak peek on the remaining 2021/2022 opportunities for you all. Briefly, I want to discuss the end of quarter schedule. Dave mentioned this, but it always helps to provide a little bit of a reminder. Yesterday, you received your quarterly newsletter. Inside there, it shared that your 3Q commercial and multifamily property investment overviews, as well as applicable disbursements, will be sent and shared with you by November 2nd. And another friendly reminder that the recordings of the commercial and the multifamily reviews will be shared with you by the end of the week this week, October 29th. All right, before we jump into that Q&A, we do have some upcoming dates for you in regards to Greenleaf Connect. We just did the commercial review. Right after this, we will be doing our multifamily review. So feel free to register for that one as well if you haven't already. And then October 11th, we do have a new deal upcoming, Covington Flex. We will be providing a new deal overview for you all. This is a friendly reminder that our Greenleaf Investor Forum is rapidly approaching. Today is the final day to register, so feel free to reference any of our communications. The recording email will also have a last-minute link as well, or you can directly reach out to myself, Dominique, and I'll help you out.
And Dominique, I believe Covington Flex is November 11th?
Ooh.
Or October 11th?
November 11th.
November 11th, okay.
It's all October right now. November 11th, that is correct. Thank you so much.
Yes.
All right, we're going to jump into Q&A, and I will pitch this over to Natalie, and we can get started on answering any questions that have come in so far.
Thank you, Dominique, and thank you to everyone who submitted questions. We also want to remind you that you can continue to use the Q&A feature at the bottom of your screen to submit questions as we work through those.
As long as they're easy, only easy questions.
Oh, no, we want some hard ones for you.
Yes.
First, are we seeing any non-paying tenants or an increase of those due to COVID-related reasons?
Well, I think the best example we have of that is what happened last year with our Edgewood property, where we had a single, actually I wouldn't even call it a mom and pop, it was a single operator who just couldn't figure it out. He couldn't figure out COVID, and he also had some other stuff going on. But Edgewood was closed. We took possession of it, cleaned it up, and got a new tenant in it. And as far as other retail tenants, we did do some early COVID concessions. Everybody was making deals. We would do a little bit of free rent. The banks would defer the mortgage payments for a few months. But in the end, everything caught up, and we are out of all the COVID concessions. In fact, one of our properties, Charlie's, we're still collecting an extra $1,700 a month because they're paying back the COVID concession right now. Yeah. And
we haven't had any additional delinquency or any payment-related issues due to COVID or business performance. The only thing we've had is we've had some M&A activity with some of our tenants. doesn't affect occupancy, but it's interesting to see as places are being basically purchased and rolled up. But they're keeping their leases and keeping their locations. So, but we haven't had any delinquencies related to COVID or anything.
Yeah, and I'd say it's pretty easy to say that March, April, we were all trying to figure out what we're doing, and we tried to write the course, and we figured it out. We moved forward, we changed strategy, and our strategy is working right now. Drive-throughs are amazing, and we have a focus on Dollar Generals, drive-throughs, partnerships, and so we're focusing on everything that works pre-COVID, during COVID, and it should work post. There's no reason for it to work out.
Yeah, and on the medical side, they're relatively busy right now. So all medical is pretty much busy. And then our small offices, they're performing well and people are there. And we're excited about the industrial flex stuff because it's being very heavily used right now.
In fact, we actually watched the medical prices go up during COVID. So we were buying medical early on when medical was a little bit less than it is now. And then right now, literally, we're watching it doing the same thing apartments did, where the values are getting too high for us to. Those deals that are
getting harder and harder to find deals.
Yeah, they're hard to find those deals. Yeah.
Given lower interest rates, which properties, if any, do you plan to refi in the coming months?
None for retail, as far as I know.
Yeah.
But how about
on the commercial side, most of the commercial and really the medical tenants, one of the best components of the value there is that we're able to get such good debt going into it. So we don't really have assets that we're trying to advantageously refinance to pull out equity or lower debt rates at this time. But we're going to keep an eye on it, and we're always doing like an assessment of what does the deal look like, and is there an opportunity. So, but we don't have anything currently that we're targeting to do that with.
Okay. Our next question is a two-part question. It's a little unclear of how much of our office vacancy is due to renovation versus weak leasing market. For the properties that are ready to rent, can you provide some color on churn of existing tenants and market uptake? And then the second part is, what should we expect to see on occupancy in the next 2 to 4 quarters?
All right, so the first part of that, the vacancy at the Lupton, the biggest issue we're running into there now, supply chain related, is our windows that we need to get CO on the building are not here.
Are your windows on a boat off the coast of California, or they're being built locally?
We're a little confused where the windows are, but it's been taking a while on the windows. We have everything ordered and we're just waiting on delivery, but that's not going to be until January now, is our latest update for that. So that vacancy is due to renovation. The 1500 North Graham asset, that vacancy, we just finished our exterior and interior build outs there in the past really 3 weeks. That ended at, we finished at the end of the third quarter, and now we're in negotiations there right now with a medical tenant to take some of the space. But that vacancy was primarily due to not having a CO that anyone could move into, therefore. We have that now. The other parts, when we look at Johnson Square and the station or Crossing Center 2, each of these have vacancy in them. None of it is currently related to renovation work. So the station, we had spaces we had renovated, and our target there was to get $16 a square foot. We're getting more for our classic space. We're getting $16.50, $17 a square foot for classic space. So we're seeing gains in the classic space, but we have this renovated space that we can't lease. There's not a lot of demand for that. So is it a renovated space? I mean, it's done renovated, but not currently in demand for what the existing market is. The existing market is 1,000 square feet. They're ready to move in that office right now. Like, they want to move in this week, not 2 months from now, or they don't want to do any build out. They just want to move in right away. So what's occupancy going to look like in the next 2 to 4 quarters? That was the other part of the question, right? So as we basically look out through 2022, with North Graham and Lupton coming fully online, we expect to see pretty substantial occupancy gains there. And on the station, Johnson, and Crossing, we expect to see incremental step-ups each quarter, gaining a couple percentage points. But again, those are all smaller footprint tenants, so we can't have a huge increase because they're all smaller tenants there.
We have a couple more property-related questions, a lot of them on leasing and time frames. So the first is on Parsons. Can you give more specifics on the plan to lease and the time frame to do so?
So we have two vacant suites at Parsons, and there we have an agreement with a listing broker to do the leasing, specifically focused on medical tenants. One of the other things that happens with when we're specifically looking at medical tenants is you can't put multiple of the same medical tenants in the same location. Like a dentist doesn't want to be right next to another dentist. Like it's probably not the greatest business decision. So we already have a few tenants there, and then other ones in the complex. They also, you know, we have to pick and choose and make sure that we can lease to a tenant that can be in that space. So we're a little more limited, saying like, hey, we're only going to do some tenants, and they have to be medical. And there we have, it's about 3,500 square feet of the 2 suites that are vacant. So these are smaller office groups that would want to move there. We've had success with, like at Johnson Square, we have one of our Parsons tenants that also went over to Johnson Square and leased space there. But that space with the medical tenants is all done through broker relationships. We don't do any of that leasing internally. So our time frame from that, while we're putting out the way that we see to attract more tenants to that is really offering larger TI packages and the commission packages to speed up the demand. And that's currently what we're doing at Parsons.
Great. And are there any potential leases in the works for Johnson Square?
In the works right now, I don't know exactly off the top of my head on that one, but we always have LOIs that we're negotiating. So we're going through multiple phases with it. One, it's like we get a report every week of how many people have just looked at it, right? So we do that part. And then is there an LOI negotiation? And then is there a contract negotiation for a lease? We don't have any right now that are in that lease negotiation phase, but we do have tours happening and we do have LOIs that we're going back and forth on, but not a full lease negotiation right now.
And regarding the station, since Classic is in higher demand, are you still considering moving the Greenleaf corporate office to the open space to open the Classic to lease to?
Yeah, it's a little bit of a shuffle. So when we purchased the station, Greenleaf, we moved our office here and we took 3 office suites that we're currently operating out of right now, and we figured, hey, we'll just take the Classic stuff that's there, kind of the same mentality of the people we're trying to lease to, but we just took our 3 vacant spaces that we could fill up, and we did the other renovation space, and now we could rent the space that we're currently in a lot easier than the renovated space. So we're going to move to the renovated space and then release all the spaces that we're in at that higher rental rate, which we're pretty excited about. We know that'll do an immediate boost to occupancy. We're able to do that. We plan to do that in the first quarter of 2022.